Good afternoon, everyone. Good afternoon. Thank you for joining us for this amazing panel. That's so refreshing to see three beautiful women to talk about wealth strategies for entrepreneurs. Sorry to Carlos, but that's amazing to see three beautiful women today. I'm going to let people come in because we had so many amazing tables today and everyone is jumping from one session to another session. I want to make sure that my speakers are all good with the sound. So I'm going to introduce you the speakers today. We are, of course, talking about wealth strategies for entrepreneurs with JP Morgan. The executive team today will talk about it. We have Églantine Courtière, Executive Director. Églantine, bonjour.
Bonjour.
We have Meredith Mo Peguero, Executive Director also with JP Morgan. Hello, Meredith.
Hi, thanks for having us.
Thank you. Elizabeth Sutherland, Associate Banker with JP Morgan Private Bank.
Hey, Rachel. Thanks for having me.
Thank you. And the best for the end, Carlos Battle, Managing Director and Senior Wealth Advisor with JP Morgan. We have all the team today. Hi, Carlos.
Bonjour, hello, hola, ¿qué tal?
Hola. What a multiculturality. That's Miami, right?
It is indeed.
Yes.
Thank you for joining us very much.
Thank you. So we are super excited today to talk about wealth strategy for entrepreneurs, preparing your personal balance sheet for a future liquidity event. So I'm going to give you the lead, Églantine, and I will let you introduce your table and your topic today.
Perfect. Thank you very much, Rachel, for the introduction. So I'm going to kind of go back to the introduction quickly just to make sure you understand what JP Morgan does and what we do within the bank. So as Rachel mentioned, my name is Églantine and I'm a banker for JP Morgan within the private bank. So I cover 30 families based in Florida, mostly business owners and tech entrepreneurs. So I'm joined with three of my colleagues, Meredith Peguero, and she guides in particular business owners, tech entrepreneurs, but also their families through the complexities of significant wealth. And Mo has spent time in an early stage company, so she will bring to the conversation some kind of first-hand perspective on how to deal with the difficult decisions around pre-transaction planning, raising capital, and ultimately the sale of the company. Then Elizabeth Sutherland, so she has been my partner for the past 3 years, and she guides clients, mostly tech entrepreneurs and financial principles, advising them in thematics around investing, lending, and wealth strategies. And last but not least, Carlos, as you mentioned, is the managing director and senior wealth advisor for the private bank. And we tend to say that the way you own your assets is as important as the way you invest them. And that's where Carlos comes in. He's our expert, guiding clients through all the thematic around structuring and wealth planning. So as Rachel mentioned, the topic of the discussion today is wealth strategies for entrepreneurs and how to prepare your personal balance sheet for future liquidity event. So what does it really mean? I would say that just like the roadmap every entrepreneurs have for their companies, you should have a financial plan for your personal balance sheet. And in the interest of time today, we're just going to review 5, I would say, key components of this plan. But something that is the most important to keep in mind is that you need to operate with intent. So going right into the subject, Carlos, can you please walk us through the different type of ownership of an entity? What is a qualified small business stock, and why should every entrepreneur care about it?
So thank you, Églantine, and thank you, everyone. The first step is critical. The first steps in how we organize a business are critical. And essentially in the United States, I'll break it down, 3 forms of ownership: Within those three, there are subparts, but three general forms of ownership. First, sole proprietorship. That is an individual who owns a company on his or her own. Second, it's the corporation. Corporation, where an individual owns shares in the company, individual or individuals own shares in the company. And that corporation comes with significant benefits. It provides personal protection for personal liability, and it provides other benefits as well. And then third is a partnership. And a partnership is kind of a combination of the two. It's taxed differently, but it provides some, but not as much protection as a corporation does. Taxes are important here as we go through this, because on a corporation, you will be taxed twice. You will be taxed when you receive dividends from the corporation, and you will be taxed on your personal income taxes that stem from that corporation. On a partnership, it flows through to you, and there's only one level of tax. So it skips that corporate level tax and comes right down to the individual. Oftentimes what we see formed nowadays, and for a long, long time was when I was in practice, the sort of in vogue entity was an S corporation, which is a corporation, but that you can elect to have taxed as a partnership. So instead of the two levels of tax, you have only the one level of tax. And when you had a 35% corporate tax rate, you really wanted to avoid that 35% tax rate. So we saw a lot of people establishing these S corporations or these partnerships. Now, what happened a few years ago was that corporate tax rate dropped from 35 to 21%. All of a sudden, not that much different. So maybe there's a benefit to having the corporate tax status with all of the other benefits that come from it, particularly if you're thinking of someday going public, because this is an important way of doing it, of holding your assets. And in addition to that, there was this law that was sitting on the books called Qualified Small Business Stock Exclusion, section 1202 of the code. And everyone hates when tax lawyers speak in code. Promise you that's the only time I'll reuse a tax code section. But section 1202 of the tax code, qualified small business stock. If you held your company, your interest in a company, in qualified small business stock shares in the corporation, in a C Corp, traditional C Corp, you held it for more than 5 years, and that company at date of inception was valued at less than $50 million. At the end of the process, if you sold it, the first $10 million of gains was completely excluded from capital gains tax. Now that's extraordinary. Think about the numbers when you run the math on that. So that's something that we saw a lot of people walking into, particularly a lot of entrepreneurs starting their companies, thinking, you know what, maybe C corporate status is better than the S corporate or the partnership status, because I get this $10 million tax-free benefit at the outset. 100% of the gain, if you click all the criteria, is excluded from taxes. Now, quick caution, because Congress has thrown us a little bit of a curveball on this. And instead of that 100% exclusion, under the bill that's currently before Congress right now, we can take a real hit. So instead of the 100%, you get only a 50% exclusion from the gain. So it's a significant, and when you run the math, it actually makes things a little bit worse. So keep that in mind as you go through it, that it might not be as beneficial today if this law passes. So that's essentially it on QSBS. Very important to know, something to put in the back of your mind as you start that company. One thing, Glenty, we always talk about the importance of being surrounded by good advisors, not just the four of us here on the screen, but a great accountant and a great lawyer. Those folks will help you think through those steps at the outset. Don't just jump in and say, oh, S Corp or C Corp. Think about where you want to see your company 5, 10 years down the line, 2 years down the line, and walk through the process that way.
Perfect. Thank you, Carlos, for this information. It's obviously a lot to keep in mind, but it's a good, at least I pointed a few notes to ask my CPA about. So thank you for that. So assuming that now I got my entity structure correct, thanks to Carlos, Elizabeth, can you please help me think through what I should be doing to be well prepared for the next stage of growth of my company?
Of course. So in the early stages, we work with entrepreneurs in thinking through the following 3 points. The first being setting up an ownership structure for tax efficiency. This is what Carlos just mentioned. The second being cash management. It can be as simple as a checking and a savings account with credit cards, or more complex cash management strategies after a fundraise. And the third and final point being, make sure you're surrounded early on by trusted partners. At JP Morgan, we are happy to share our network of senior executives and industry advisors, and we can also make introductions and referrals to CPAs and attorneys.
Perfect. Thank you, Elizabeth. That was actually easier to think through than what Carlos just mentioned. So I'm happy now I'm following better. So now let's do back the summary. So I have my entity structure correct, and I'm surrounded by trusted advisor. Mo, can you please help me think through my company, but in my company structure, but in the equity standpoint? So how should I think about the incentive plan?
Yeah, thanks, Eglantine. So, what's really important as you're thinking about building wealth, and what Eglantine said at the beginning is what you really need to always keep in mind. You're building a corporate balance sheet at the same time as building your personal balance sheet. And it's really important to think that way. You use your company stock, the equity in the company that you're building, in two ways. One, you're going to use it for employees to attract talent and then to have them stay there. But the second way that people often forget is you're using it to build your own personal wealth. So it's really important that you have a thoughtful plan into how you're structuring that incentive plan. So essentially all that is it's saying we're going to set aside a portion of our stock and we're going to use that to make grants to current advisors, to current employees, including yourself. You should always make sure that you're paying yourself market value, and to potential employees. This becomes really important when you get to the point of growth where you're attracting C-suite type of executives. They're going to expect that you understand their market value. They're going to expect that you have the structure in place to be able to issue options and restricted stock units to them. And they're going to also expect that that is going to be a part of their compensation moving forward. Remember, in the beginning, you probably don't have cash to pay these people, so you're going to use your equity, but you also need to remember that's one of the most valuable things that you have going to the second part, which is the equity for yourself and how you're building your personal balance sheet. It's really important that you understand the terms of different types of stock, different types of options, and what they're used for. This could be an entirely different session, but there are different ways that you can set up those grants that are focused on either encouraging employees to perform a certain way. So here are some issuance of options, but you don't get them unless you sell X amount within 1 year. You might say, if you sell X amount in 1 year plus a little bit more, we're going to give you extra. There are a lot of ways to shape this where you can really incentivize and motivate people to perform and to do what you have them on board to do. The other part of that is you really want to make sure that as you think about growth in your company, you're paying attention to something called dilution. And that's essentially the idea that as you go out and you give more and more people stock, that means you have to go back to the bank and you have to issue more from your company. That's cutting up the pie a little bit into smaller portions, and that can get dicey. That's not only decreasing your ownership, it's decreasing the ownership value for your early investors and for those employees. So that's all to say it's really important to have that incentive plan created in the beginning, not just at a boilerplate model that you can get from any attorney that you work with. You really want to back into what am I trying to accomplish with my equity, both on the result of future business for the company and for talent that you're going to have there, and how am I using those tools to get there. And it's a bit of an evolving journey as you go through raising different rounds of capital, but you need to be thoughtful of it from day one, or you'll find yourself in a situation like we have seen several times of very successful entrepreneurs who got diluted to a very small percentage, and you see a huge exit number for the company, and unfortunately their personal balance sheets aren't realizing it. And so it's worth the time to think about how you're going to leverage this special tool, but protecting yourself to know that at the end of the day, your family and your personal balance sheet will be able to thrive alongside that exit.
Thank you, Mo. When I take really from it, it's what we spoke about at the beginning, to operate with intent. So kind of understanding everything that you put in place for your company, but for your personal balance sheet too. And maybe as a follow-up to that, Mo, because you have helped clients going through multiple M&A or IPOs activity, what should our audience know in terms of pre-transaction planning?
Sure. So pre-transaction planning is kind of a fancy word that we use, but really it just means planning along the way. So anytime that you're going to see an increase in valuation for your company, you need to think about how that impacts your personal balance sheet. Those increases in valuation happen when you go from your seed to your Series A, when you take on a new investor and that valuation is now at a higher level. As you go further down the road and you're past growth equity and you're thinking about a potential IPO, or maybe you get scooped up in some transaction and somebody comes and wants to acquire you or merge with you. All of those transactions are going to come with a step up in the overall valuation, which is great for us and also the IRS. So we want to be a little bit thoughtful before you see those bumps in valuation and say, hey, how can I be strategic and thoughtful with the equity that I own so that I can minimize the taxes that I'm going to have to pay as I see those bumps, albeit good bumps that we want to see along the way. And that's something called pre-transactional planning. So if you, as an entrepreneur, have the intent of gifting to either your kids, so think a generation below you, or maybe even your parents, we're seeing a lot of what we call upstream gifting to first generation entrepreneurs who say, hey, you know what? I want to be able to get some money to my parents. And so we're looking in both directions of making these gifts. And then the third bucket is always charity. So if you have any philanthropic intent, it's also a category that we think about in terms of this pre-transactional planning. And the punchline is, without being technical, there are ways you can gift stock before you have a valuation increase. It can either be an outright gift or a gift that you get something back. And I'm teasing a little bit on Carlos because he'll give you the technical side of this. But the idea is, before you have any transaction, so before that valuation is going to go up, you do some planning to decide, at the end of the day, I really want to give money to my kids, give money to my parents, give money to a charity. Let's think about how much that is. And you can model all this out. This is not something you're just pulling out of the sky. You model real numbers to see the potential increases in valuation. You put them in different structures in your modeling before you do it. And then you're able to say with confidence, yes, I would like to gift some shares. And these are going to be through trust structures and other kind of complicated stuff. But I'm going to gift them at this lower valuation, minimize or avoid taxes. And then when you see that increase, it's off your personal balance sheet and you're not paying the higher tax level for that. So, I think there are a lot of tools that we use to do that kind of moving around, and the minimizing of taxes. But one that I love, and I want you to kind of just remember this word when you walk away, is the GRAT. And that's a grantor retained annuity trust. But in banker talk, it's the GRAT. And so I know Carlos is going to go into this. It's part of a bigger estate plan, but this is something that my clients use all the time to be able to minimize taxes and to get some of their wealth to their peers.
Thank you, Meredith, for the details. So now I want to know about the details with Carlos and all the technical part coming from you.
Now, I will try not to be too technical, but Mo, I love GRATs, and I think it's such a powerful tool and such a great way for our clients to save money. And you talked about those different groups that can benefit: the family, charity, the individual themselves. That's where we want to keep the money, in one of those three assets. And we want to make sure to do that. Now, GRATs are a great way to do that. I want to touch on GRATs in a few seconds, but before I get too excited, let's just talk about trusts in general. Talk about estate planning and make sure that you're properly structured at the get-go. Take those first steps properly. One of the things we often suggest our clients to do is to set up a revocable trust. That revocable trust can hold assets, that can hold the individual's assets and minimize the probate process that you'll often hear a lot about. And also, if you become incapacitated, it can potentially eliminate the need for having to run down to the courtship and open a guardianship for that individual. So if I'm incapacitated but my assets are held, in a revocable trust, my wife doesn't have to run down to the courthouse, open a guardianship process, which can be very intrusive. And instead, the funds are already within the revocable trust. That's a revocable trust. I can change it at any point in time during my lifetime. I can do whatever I want with it. It's my tax ID number. It's my social. There's also irrevocable trusts. The trust Mo mentioned, a GRAT, is an irrevocable trust, meaning once I've made that transfer in, it's gone. It's no longer mine, which is good from an estate and gift tax perspective, because if it's off my balance sheet and onto the balance sheet of my children, when I die, whatever is on my children's balance sheet is not going to be subject to that 40% estate and tax, which is very significant. So that's what we want to do with a GRAT and with other irrevocable transfers. A GRAT works as follows. And one of the reasons you like it, it's a little bit of a have your cake and eat it too solution, because you're able to gift the asset into the trust. So you give shares of your new company that's worth, you give $1 million of shares of your new company into this GRAT. For 5 years, you are going to get an annuity, grantor retained annuity trust. You're going to get an annuity stream based on an interest rate that is set by the IRS every month. Month of November, it's 1.4. Month of December, it's 1.6. So you will get your $1 million back plus that 1.6%. If your company went from $1 million to $10 million in that 5-year period, that $9 million swing, okay, so it's 9 million minus the 1.4%, but that $9 million swing is going to pass to a trust for the benefit of your children. So now all of a sudden your children have $9 million. You still have your million, Eglantine, which is good. You still have your million, but your kids have the $9 million. And when you pass away, how much estate tax is there on that $9 million? Zero. So that to me is one of the reasons that I love GRAT so much, because it's an opportunity to move assets off your balance sheet, but not diminish your balance sheet to the point that you're left without funds.
Thank you, Carlos. And for the audience that would think that this seems a bit like far away, already gifting while you're just like starting a new company, what will be, I would say, the basic estate document to have in place from day one, I would say.
And that's a
Although,
Go ahead, Mom.
I was just going to interrupt and say, it's actually not. So the great thing about a GRAT is the most valuable time to do it is when your company stock is worth nothing. And the only cost it is to you is the cost that a lawyer will charge you to write up the document. And so if you have a stock that costs 5 cents a share right now, before you go through those different valuation pops that I'm talking about, imagine how much appreciation you can pass on. And so a lot of this stuff, even though you probably always thought, okay, I don't need to worry about that until someone's buying my company. I don't need to worry about that until I'm going public. I don't need to worry about it, period. That's not true. These are the type of strategies that you can do now at a very minimal cost that will have a huge savings later. And
the GRAT is probably the easiest way to explain that. But there are other alphabet soup strategies out there. Intentionally, a sale to a grantor trust, or a gift to a grantor trust, or a charitable lead annuity trust, a CLATS, or a charitable lead unit trust. All of these.
Carlos is getting crazy.
I'm not going to use code sections though, but all of these strategies follow the same concept that Mo mentioned. Give something away with really low value, let it grow in the name of your children, of your grandchildren, and minimize the estate tax burden along the ways. But going back to that basic estate plan, which again, all of this is get things in order at the front end. Part of the basic estate plan, if you're a Florida resident in particular, you're going to want to have a will, because if you don't have a will, you will have a will, except that you won't write it, Eglantine. The state of Florida is going to write it for you, and you're going to have to follow the Florida rules. And unlike other countries, there is free disposition of assets here. We are able to leave assets to whomever we'd like. There is no forced heirship there is in civil law countries. So a will is very, very important. You're also going to want to have the revocable trust that we talked about earlier that can in some ways act as a will substitute. And then for during your lifetime, you want some things that are very important. Powers of attorney that allows someone else to handle business assets and handle financial assets for you. Healthcare power of attorneys that don't do with business, don't do with checking accounts that Elizabeth talked about, but rather deal with what happens if I get sick, who's going to make decisions on my behalf in those ways. Those are, I would say, the 4 core documents that you need at the outset. And those 4 core documents will also provide some guidance. Well, not just guidance, but the rules around how your business passes from one generation to the next. So if there's no liquidity event, who's going to run the business after I'm gone? And who's going to inherit my shares? So sorry, I talked a little bit long, but go ahead.
No, but thank you for all this information. And maybe because it was a lot in only 30 minutes, to maybe summarize what I understood took it from the conversation. It was that no matter what stage you are in the life of your company, it can be a startup or you are can be preparing your exit. It is really important to operate with intent and have control over your financial plan. So understand what you're doing. And I would say the 5 components that we reviewed today would be, first of all, to check with your CPA the optimal ownership structure for tax efficiency. It could be a C Corp, as Carlos mentioned, or something different. The second would be to get surrounded by a group of trusted advisors, like capital partners, but also CPA or attorneys, as Elizabeth mentioned, and we are happy to make introduction if that's helpful. The third would be to think about to understand your incentive plan, to retain and attract talent, but also to make sure you're paying yourself correctly too. So that's a point that Meredith mentioned. Make sure you also have a pre-transaction planning in place before negotiating any exit. And it can be through gifting strategies or just understanding what will be the consequences of going public. And I would say last but not least, make sure you have all the estate planning document in place. It can be as simple as a will or a power of attorney if anything happens to you, or you can take a step further and talking with your attorneys about trust or gifting strategies like the grat that we mentioned today.
Yeah, and Eglantine, I think, just one other thing to mention that's really relevant for this group is the fact that as an entrepreneur and as a business owner, you're going to be managing what we call a concentrated position for the course of a long time, maybe your entire life. You might not see it as risky because you know everything that is about that company and you built that company, but it is risky because it's not diversified, and that means anything can happen. And so something you need to think about along the way as you bring in these advisors and develop these plans is, how am I managing against that concentrated position? And the reason I want you to think like that is because if your goal at the end of the day is to have a certain amount of money, to have the company thrive, to create wealth for your family, whatever your goal is, it's going to have to take into consideration that you're not like a traditional investor that's operating in a way of accessing kind of that pie of different asset classes that has different volatility and different levels of return. You're very concentrated and your cash flow is going back in your company. And so it's important when you work with your team to think through, how am I managing that? How am I solving for my own family's liquidity needs? Think about things like, if I need to buy a house, if I need to pay for college, if I need to XYZ, that's all stuff that you have to put into your plan and realize that it's always going to be there. And I bring it up because sometimes we forget that it's our biggest asset, even though you see it every single day, but it's harder to develop that financial plan when you're not just well diversified and kind of chunking along.
All of what you just said, Mo, and the 5 points that Eglantine, they're all interconnected. It's all part of the same plan. Making sure you're well planned in advance, and as we've all said, that you continue to develop that plan as your company grows along with it.
Exactly, because this planning takes time, and it's obviously a lot of information that we shared with you. You're not going to have everything set up in day one, but at least it's key points to keep in mind and to ask your advisors about, to make sure you're on track to achieve your goals.
Thank you, Eglantine. Thank you to our panelists. Just as a reminder, you will be able to make appointment with our speakers by clicking on their profile. I invite you also to meet all the experts in the expo session on your left. And I will thank right now our panelists. Thank you so much to JP Morgan for being here with us and giving us such a great content. And see you soon, next year maybe, for another Miami Live. We will start right now in session, the last table of the day. We will talk about land investing platform in the United States with Landquire. Thank you very much, and have a wonderful rest of the day. Thank you, ladies and gentlemen.
Bye-bye.
Bye.
Thank you.